one of the things that's interesting to explore is this pricing differential between prime and the secondary, and obviously secondary encompasses quite a wide range of property. But it's the area at the moment in the market where you've got the biggest difference between where vendors are on pricing and where purchasers want to be. And typically when I'm looking at transactions at the moment, the vendor sees that big margin between prime and secondary, perhaps has a property with a good cash flow and says, look, this looks like I've got a big margin, it ought to be an opportunity, you ought to be able to achieve sales at that kind of discount to prime, which might be 150, 200 basis points. The buyers, on the other hand, are looking at that income and they're saying, well, I'm very unlikely to get any rental growth on this secondary property. I can't leverage up very highly. I've probably got to put in some capex even to stand still. And actually, a 200 basis points difference between prime and secondary isn't enough to get performance out of that asset. And we're seeing that a lot. And I think a lot of the property that is on the market is potentially of good quality, but it's not prime. It's not going to get performance driven forward by tenant demand that comes easily. It's going to need to be managed and actively managed. So, maybe, Peter, some further words on the German market and where you see the difference in demand between the prime and the secondary side.
Well, I think it's that's been going on for quite a while, John, that we've obviously got a surplus of demand for prime properties in the market. So if you put a prime property to the market, it generally sells. That's not the issue. So the question is, what are investors going to do? Are they all going to continue to chase the same product, or are they going to broaden their view on where they want to go? And from certain investors, we are seeing that they are potentially moving away from the typical prime top 5 CBD property into sort of the other regions and then into smaller towns in Germany, which as such also makes sense. But there in those towns, they would only want to buy the better properties because those are the ones which have been successful in these cities for a long period of time. So we can see that, which I think is probably an obvious thing to do if you need to invest into, if you want to invest into Germany, into real estate. It is certainly sensible if you start to broaden your focus, and that's where the secondary market comes into place. In terms of pricing, obviously, the prime end of the market is where it usually is, somewhere around 5% for the offices and a little bit lower. And in the secondary markets, we are at least 100 basis points higher. If it goes into tertiary, then secondary is also always difficult to find, I think. Then it gets very, very difficult. Then the properties are difficult. You don't get the financing even from the local Sparkassen. It gets tricky, and that's when I think pricing from a vendor side matching the buyer side, sort of the gap is still too large.
Yeah. So Phil, taking that one step forward in terms of prime, you spend your life, not all your life, but a lot of your life dealing with prime and prime retail in London. You get all the big jobs. Phil is our head of retail investment in the UK, and you get to deal with Bond Street and all the prime streets that you've been dealing with them in the past couple of years. Is that still the case? Are we still seeing investors really looking for ultra prime property?
Yeah, absolutely. I think the key that a lot of people don't understand is people perceive it as legacy purchases for retail dynasties, but actually the rental growth that is happening in London at the moment, I mean, Oxford Street did 20% last year. Now, there aren't many UK cities that are doing 20% retail rental growth. Bond Street is doing between 3 and 6% per annum, has done for the last 8-9 years. You've seen a doubling of rents in Bond Street to £1,000 a foot. So it isn't legacy purchasing. These are investors who are hedging against rental growth. We're seeing a lot of activity from retail dynasties buying into this space because it's a competitive edge. They like owning their competitors' buildings. But we've also seen a lot of supply. Obviously, the Irish were well documented as buying heavily into the UK and into retail, particularly in London. And because of the leveraged nature of those transactions, they've had to divest. Now, that gave a lot of international money opportunity to get a stake in what are some of the most iconic streets on the globe. So it's been a very busy period. I mean, we're doing about just over 2 billion in retail, and we're not seeing any slowing this is just for London retail investment, and we're not seeing any slowing of demand. Obviously, this is a European audience, but my market is very much to the Far East. We're seeing a lot of Hong Kong money coming in. We're seeing a lot of Malaysian and Korean money looking at retail.
Phil, is it just London, or is it the UK generally?
Well, I mean, the interesting thing is it's nice to see Manchester getting a mention for the Trafford deal, but you watch out for Sheffield next year when Meadowhall sells at 1.6 billion or whatever the final price will be. But they look at the large shopping centres are on the map, the super regionals, which is where the retailers want to go. Where you see retail demand, you get rental growth, you get investor confidence, and the super regionals are where the Koreans, the Chinese, the Australians, the Canadians are all looking to invest. And from a personal perspective, I see that in Europe as well as the UK. So it goes back to Peter's point about prime and secondary. There are only 6 super regionals in the UK. Where else are you going to buy the sort of covenant profiles and the income flow you want? So they are going to look into other regions. And interestingly, Central Eastern Europe is seeing fantastic rental growth. So that's why, presumably, that obviously showed a lot of investor confidence last year and again this year.
Yeah, I think the point on the 2 points, the high street and the shopping centre side. The prime high street side, which traditionally very little trading, is definitely picked up. And we've formed a new group last year called Prime Retail Transaction Group, to deal specifically with the very luxury locations and the investors who are operating globally in that sector. And it's amazing, really. We were involved in advising on a transaction in Paris. I don't think we can say too much about it, although it has been in the press. But all the top bids were 100% equity, and you're talking of the building over 160 million. And there's a very sort of specialist but reasonably large group of investors who are active in that sector. And then moving on to the shopping centres, what has changed quite a lot on the bigger schemes is that global capital has come in and been prepared to take a stake, not 100% ownership, but very happy to take 50 to maybe 80, maybe 90% even, stake in a shopping centre, leaving a local expertise in there with some of the equity and the active management piece. And that's been a big part of the market, and a big part of what we do at the moment actually is putting some of these groups together around a transaction to make it work.